Again, thank you everyone for taking a few moments out of your day to be here. Today, as you can see, our topic is going to be about investments and investment strategy. And when we look at the different types of financial education that all of us do here at Financial Fitness for Life, I think that investments is probably one of the most frequently asked for topics. And so today we're going to kind of walk you through some different types of investments, how to figure out your strategy, and also what are some of the questions that you're going to want to be asking yourself as you're starting to look at your own strategy. And joining me today are John Poole and Josh Zeb. They are two of our financial consultants. My name's Kyle Bingham. I'm the managing director for Financial Fitness for Life. And with that quick intro, let me go ahead and walk you through the agenda. In this first section, we're going to just talk about understanding investments a little bit better. We'll talk about what is an investment strategy, why you need one. Then we're going to talk about the old adage, don't put all your eggs in one basket. I'm sure you've all heard of that before, but more often than not, people really don't understand exactly what that means. And then lastly, we're going to talk about some of the different types of investment risks. How do different investments have different levels of risk, and how do you kind of measure that and then figure out what your own risk tolerance is? And then we'll move into the second section, talking a little bit more about finding those right investments and finding that right strategy. We'll kick that off with whether or not you're a do-it-yourself investor. This is probably one of the most important questions you need to ask yourself as you're evaluating your strategy. We're going to talk about stocks, bonds, mutual funds, exchange traded funds, and help you to understand what types of investments you should be using. And then we'll close things out talking about some of the most important factors that you need to consider when you are selecting investments and your investment strategy. And so let's go ahead and kick off this first section of understanding your investments. And so, John, why don't you walk us through this first question? So what is an investment strategy, and why is it so important to a person's financial plan?
Well, thank you, Kyle, and thank you all for clicking in or dialing in today. I think with anything, any action or plan that we want to work or take or make, we need to know where we're going. We need some sort of roadmap and destination in mind. It's if you can remember back when you were in school having to write a book report or something, you wanted to make an outline, and this is just that outline. It can be a very broad outline, or it can be as detailed as you need, going forward. But you want to have some sort of way to think about, how am I going to achieve, whatever financial goal it is, whether it's being 401k guy, I can say, well, you're probably thinking about saving for retirement. But if you're thinking, hey, I want to save for my home, a first home, or I want to save for a rental property or something of that nature, whatever financial goal you have in mind, you want to have that goal mapped out as well as you can. And obviously, talking about investments, what type of investments are you going to have? I'm assuming that there are no lottery winners on the call today. So for the rest of us, right, we need to think about where we want to have our money allocated so that it can grow to reach our goal, and also taking into account how we feel about risk. Risk being, well, how do we feel about investments tied to the ups and downs of the stock market? Do we want to look at individual stocks or individual bonds? Do we want to look at maybe certificates of deposit, CDs down at the bank or credit union? How those are going to figure into how we feel about our time frame to accomplish this savings or investment goal, and then our risk associated with the different types of investments. And I do want to touch on one thing really briefly before we move on. We want our decisions to be data driven. Well, yeah, of course it's going to be data driven. What else would it be driven by? Well, I'll submit this to you. Some people think, well, I really like this mutual fund, or this company really speaks to me. I like Coca-Cola, or I like Disney, or I like Apple. Okay, great. You can like all of those companies, or you can like certain funds. For example, I would suggest to you that you look at the data. Let's look at the hard data and see where each of these investments have performed or not, and whether they do in fact fit in with your overall plan. And then
Excellent.
moving.
Yeah, John, I definitely agree with that. And to your point, it provides structure. And I love that point about it being data driven. It gives you a way to kind of hold yourself accountable and prevent you from overreacting or making those emotional decisions. So again, this is kind of that first step. Now, moving on into this adage that we've all heard many of times, don't put all your eggs in one basket. John, can you walk us through what does that actually mean, and how does that relate to investments and investment strategy?
Sure, and I know that we've all heard this and maybe exactly this way, or maybe in other ways that get kind of to the right or to the point of don't invest all of your money or a large portion of your money in maybe one specific investment. Let's say that could be one company stock, or maybe one mutual fund, or one bond, or it could be even one category of type of investment, right? Um, what if something happened to that sector or that company to where your investments, while you've done all the research, all that data that you've looked at, it had indicated that, well, this company or this sector or this category of type of fund, for example, has done really well for the past 12 years. And so I think that's safe. I'm going to put everything. I'm all in. I'm pushing all my chips in that general direction, and then something unexpected happened, and then you really set yourself up for overexposure or a real loss. That would be a shame. We don't want that to happen. I would suggest to you that maybe you think about, well, I can like this sector or this type of investment, but also there are maybe a couple of other investments that aren't directly tied to the one that I initially chose. Maybe in other sectors, maybe other industries, or maybe other type of investments altogether, where you can see some growth for your money as well. That way, if something rises or something falls, you'll have a way to kind of even that out.
Exactly. And I think, going along this same adage, when you're thinking about don't put all your eggs in one basket, what you're really doing is you're figuring out how many baskets you're going to have, and then how many different eggs you're going to put into each of those baskets. And we're going to expand on this concept a little bit more as we start talking a little bit more about investments themselves. Now, another really important factor that we have to start to understand are the different levels of risk that are associated with the different types of investments, whether we're talking individual stocks or bonds, looking at mutual funds and other types of investments. So, John, can you walk us through, like, what does that process look like, and how can you help people understand a little bit more how to understand risk and how it relates to all their different investments that they may be looking at?
Yeah, I was actually talking to a client, I guess it was last week, and was asking him, so, well, what do you want to accomplish with these investments in your 401k plan? We're talking about his retirement plan. So, well, I want to grow my money as quickly as possible, and I want to really build up that nest egg sooner rather than later, but I don't want any risk. Me too. but but realistically, what we can think about when we're talking about risk versus or as it relates to different types of investments, typically the lower risk that we assume, the lower potential returns, right? Because these are going to be safe investments that are not invested or exposed to any sort of volatility and invested in anything volatile. And then, of course, if we would like higher potential returns, then we should plan to assume higher risk or a higher amount of risk. Something to consider. So the client that wanted no risk but extremely high returns in a very short amount of time, again, who doesn't? but realistically, there are different investments to look at, and then understanding how those investments typically are aligned with risk is a great place to start out. And then that next step would be, well, how do I feel about risk? Well, and as we can see from this graphic here, we have, of course, the potential return on that vertical axis there, and then horizontal with risk, right? And so we have that yellow bubble circle there, cash, and that can be a checking account, a straight savings account. It could also, you could even lump in there maybe a stable value fund, something like that. Very low volatility, very low risk, not tied in with the stock market. You're not going to have a lot of wild ups and downs. And then moving up, as we see, there's bonds. So bonds, as a debt instrument, you're loaning an entity money and getting probably a stated rate of return, right? So you know what to expect. It's not going to wow you. It's not going to be very exciting. It's not going to be anything like a Beyonce concert, for example. She just played here in Houston. I throw her out there. I'm not a member of the Beehive, but bonds are going to be pretty middle of the road, very slow going, but you can expect it. This is the one joke we have in the whole presentation, by the way. And then as we get to higher risk, that's your stocks there. So we can think of stocks depending on the type of company, the industry, the sector. Those stocks can be very aggressive growth, very very high risk. They can be more moderate risk. But just understand that cash and bonds going to be less risk assumed and lower returns potentially than your stocks. We can all see that there, but it's just something to keep in mind when not only you're selecting investments, but you're thinking about your own feelings regarding risk.
Exactly. I mean, I like to always tell clients that there's no such thing as a free lunch, right? And if you want those higher returns, you have to be willing to take on more risk. But it's important that that person understands what could actually happen as a result of them taking on more risk, depending upon what the market's doing and what the economy is doing as well. And so when we're working with individuals, we walk them through this entire process so that they understand, when I do this, this is what could happen, the good and the bad, and be able to kind of balance out the risk versus the reward. Excellent. Well, thank you, John, for kind of walking through those first couple of questions. Now I want to turn it over to Josh, where we're going to talk a little bit more about some of the specifics. So now that we understand a little bit better asset allocation, diversification, and managing risk, and understanding some of the different levels of risk with different investments, this first question that we're going to talk about here is, am I a do-it-yourself investor? Now, you may think this doesn't really relate to investments, but as Josh walks you through this, you'll see that this is probably one of the more important questions to ask yourself when you're figuring out investment strategies. So, Josh, why don't you walk us through this and talk a person through how they can figure out whether they're a hands-on or hands-off investor?
Yeah, no, absolutely, Kyle, and I appreciate the time talking about this subject. And no, I think this is a pretty interesting aspect to investing. A lot of times people think of investing as something that they're only going to do by themselves, and they're only going to have to do the research themselves. That's not necessarily the case. Majority of times people want to have some help, want to have some hands-off approach to investing. But again, there's a portion of people who want to be a self-direct or a do-it-yourself investor. Those are usually the people who understand investing and usually like it, like the idea of it. These are usually people who want to watch CNBC, want to watch Fox News, watch Bloomberg, watch how the market does over the next couple of days, couple of weeks, couple of years. Now, not everybody likes that approach, but some people do, of course. One thing that's really important with the self-direct investor is not just choosing your investments, but also monitoring those as well, managing those on a semi-actively basis, depending on your investment strategy, of course. So when you have your investment, when you have your portfolio, make sure you're disciplined with your approach. Make sure that you take some emotions out of it. That's probably something that Kyle, John, and I see quite a bit. People take the emotions into it. They watch maybe too much news on certain subjects sometimes where it influences how they feel with their investments. It's always good, regardless if you're a self-direct investor or not, always maybe having a financial professional help you, just so they can help you understand what you're invested in and make sure that you have plenty of enough information when it comes to choosing investments.
Excellent. Yeah, thank you, Josh. And really, I mean, the approach is really going to be completely different if you're that hands-on investor versus that hands-off investor. And so this is something, to Josh's point, we walk through people this process on a regular basis because it really does allow the person then the ability to figure out how to select investments a whole heck of a lot easier. So now kind of moving into this next question, we've talked about stocks, bonds, mutual funds, exchange traded funds. So Josh, how does a person, once they've decided I'm hands-on or I'm hands-off, how do they actually select the different investment options that are available to them?
Yeah, no, and you hit it right on the nail there. I mean, the first thing you really need to know is if you are a self-direct investor, if you're a hands-off investor, or if you're a passive investor. That's probably the number one thing you need to think about first. Secondly, after that is making sure you know what you have available or what options you have available. Now that can depend on what kind of accounts you're looking at. Now, of course, if you have a brokerage account or individual retirement account, you'll have a broad range of different investments you get to select from. If you're in a qualified retirement account, so a 401k or a 403b, your investment might be a little bit more limited based on the selection you have available. So it's really important just to know which accounts specifically you're talking about. And lastly, it's really important to know what your risk tolerance is or how you feel about risk. Now, John mentioned that before about kind of the risk reward factor based on certain investments. And of course, to his point with his client, we get that quite a bit where people want to see a lot of upside without taking any risk, which, I mean, it's very hard to find any kind of investment strategy with that. So what's really important when it comes to investing is making sure you know what you're invested in, as well as doing a little bit of research to understand how it works.
Exactly, and you kind of alluded to it a little bit about your risk tolerance, and I want to expand on that a little bit more with this next question that's talking about, what are the most important factors that somebody needs to consider? And again, we've talked about it. There's a number of them, but like Josh, kind of walk us through like what are the two main things that once a person answers those questions or figure those out, it'll make this process a lot easier. What does that look like?
Yeah, and hopefully people on the call right now have taken a risk assessment or have done it hopefully in the last couple of years. And if you haven't, consider taking one. We have one in-house that you can take, or you can look up online. I'm sure there's several different free examples of a risk assessment you can take. But the real indicator when it comes to risk assessment is making sure you're comfortable with your investment strategy. Now, that's probably the main thing when it comes to taking risk is making sure you're comfortable with it. Now, if someone's risk averse, doesn't like seeing volatility, they want to be more conservative, well, we wouldn't necessarily have them invested in something that was very volatile or very aggressive that could see a lot of volatility throughout the years. And the other side could be said for someone who's very aggressive. Cash or bonds or something conservative doesn't necessarily work for them. So this is a good blueprint into what you feel comfortable with when it comes to investing.
Exactly, and so the big takeaway here in particular, figure out your risk tolerance and then also get an understanding of your time horizon. How long are you investing that money? When do you need that money? And quite frankly, you may have more than one strategy working at the same time. You may have short-term goals and you may have long-term goals. Those could have different investments and different investment strategies. And so what I put together here are what I think are some really important questions that each of you can answer. And I'll preface too by saying that if you'd like to walk through any of these steps with any one of us, I'll show you how you can kind of get in touch with us and set an appointment. But first off, let me just walk you through what I think everybody tuning in today should do. First, I want you to take some time to revisit your current investment goals and objectives, okay? If you don't know what your investment goals and objectives are, that's a really important reason to make sure to sit down and have that conversation, okay? You wanna make sure that your current investments still reflect what your individual goals are, okay? Also, have any life events happened in your life that may have impacted your goals and should also impact your investment strategy, right? Anytime a life event happens, whether maybe it's a marriage, it's a divorce, it's the birth of a child, all of those things should always be kind of a call to action to go back and revisit your financial plan, okay? Then when you move into step 2, confirm what your actual risk tolerance is, okay? When was the last time you measured your risk tolerance? Have you ever even done that? We can walk you through that process, and as Josh mentioned, there's a number of good tools and resources out there that can kind of help you to measure that. And then also, are there any recent experiences that have happened in your life that now have changed your attitude towards market volatility or towards risk, right? As people are getting closer to retirement, oftentimes they do have a heightened sensitivity to risk, okay? And maybe it's time to taper back that risk or maybe adjust your investment strategy as you're getting close to the year that you're planning to retire. Now, moving into step 3, this is where you determine your time horizon. And you're basically asking yourself, when are you going to begin withdrawing the money, or how long do you need that money to last, right? When do you need it? How long do you need it for? And again, depending upon the goal, you may have a different answer with that investment approach that you take. And you can have different time horizons for different goals that you've set for yourself, and obviously different investment strategies. And then that 4th piece is going back to reviewing your current investment strategy. Have your investments that you have now, have they met your expectations? Is the performance that you wanted, is that what is actually happening, right? We can sit down and kind of walk you through what those expectations might be based upon the investments that you are investing into. And I think this is probably one of those big takeaways, is this last point here. Are you using a target date fund right now? Are you using a managed account? Are you using a risk-based portfolio? And is that indeed what you should be using? For some of you, maybe were you just defaulted in with your retirement plan into an investment option, but you really haven't evaluated what it is or how it works or whether it's right. Again, that's another example where I would encourage you to just educate yourself on it. And for those hands-on investors, a lot of this stuff you've heard and you've probably gone through the process already, right? But even for those that acknowledge, hey, I'm hands-off, I don't want to do the work, I want people to do the work for me, it's still really important for you to understand this, because then that's where you have the confidence to move forward, that you know the steps that you're taking with your investments are indeed the right steps to take. And so with that, I'm going to go ahead and put up our QR code up here for just a moment, and then I'll also send out this link in our chat window as well on the GoToWebinar console. You'll see that pop up here in just a second. If any of you would just like to sit down and talk about investments, your investment accounts in your retirement plan, or if you have other outside investments, or if you're curious about walking through a risk assessment, whatever the case might be, take a few moments and sit down and talk to one of our consultants. This is what we're here to do. And quite frankly, we probably talk more about investments than anything else. So use this as an opportunity to sit down. Again, this is complimentary. There's no cost associated with it, but I do think that this is probably one of the best ways to get answers to some of your specific questions. And then with that, I also want to remind you about next month's Fit for Learning webinar for October. We're going to be talking about estate planning, okay? And this is another one of those topics that is probably outside of investing and kind of investment strategy. This is a very highly requested topic because it's foreign for a lot of people and it can be a little bit intimidating. So make sure, if you haven't done so already, take a few moments, register for this next month's Fit for Learning webinar. I'm really excited to be able to talk through this topic. And other than that, just a reminder, keep an eye out in your email. We will be sending out a link to this recording. I saw that a couple of you had asked for a copy of the presentation. Yes, that is on your way. just give about 24 to 48 hours. And so you'll be able to go back and review that. And with that, folks, I just want to thank you all for taking a few moments out of your day to be here. Again, if there's anything else that we can help you with, please don't hesitate to reach out. And we'll be looking forward to hearing from some of you here in the near future. Thanks again, and have a wonderful rest of your day. Bye-bye.